Hi, I'm Jerry Bowyer. You're watching the Eagle Investing Network. We're continuing our series on earnings quality as a way to make stock selections. This is in the context of the United States. We're not looking at how to make stock selection in Europe or in Japan or in Latin America. We're focused right now on the United States of America. That's more familiar to most people. I do believe in international investing, and I've done a lot of videos on that. But I also believe in domestic investing. If you're investing in the United States, then you have to decide which companies to invest in the United States. This is an all-cap universe. What does that mean? It means we are talking about large companies and mid-sized companies and small companies. And let me tell you, in American financial media, it is all about the large companies. It's all about the S&P 500, really, the S&P 100 or the Dow 30. We're just obsessed over the same big famous names over and over again, when typically in any given time, somebody else in the other 3,000 or 4,000 companies is actually performing better. But we're just like in every other aspect of American culture, we're obsessed with celebrities, including celebrity companies. Well, we're looking at all the companies and we're looking at earnings quality. What does that mean? Companies have earnings, profit. There's different ways of measuring profit. You can look at gross profit. You can look at net profit. You can look at cash flow, net cash flow, et cetera. We're going to explain all of that stuff, and some of it we already have. We're just looking at different ways of measuring that. And in this particular case, we're now looking at gross margins. So this is the revenues from selling stuff minus the expenses of making the stuff. It's pretty much as simple as it is. This is the divided by the overall revenue. So this is the percentage. So if you make $100 on something and you spent $90 on it, well, then that's $10 gross profit divided by the overall margins. That's 10% gross margins. Is that math too tough? I sure hope not. But there's videos on basic second grade arithmetic if you need a refresher on that. But I'm going to assume that you get that now. So this is the gross margins are the percent return on your revenues. So it's your revenues from the business minus your expenses from making the product, divided by the revenues. $100, you sell it for $100, it costs $90 to make. That's a 10% gross margin. Does it matter when it comes to investment performance? Well, let's see. First of all, we took the best of them and put them in this bucket. We took the second best fifth. We divide all those companies into fifths. Divide them into one fifth goes here, another fifth goes here, another fifth goes here, another fifth goes here, another fifth goes here. This is the best, this is the worst. We put them here in these buckets, and then we ask a simple question. If I invested in those companies, what would happen to me next year as an investor? What would my performance be if I'm invested in this portfolio? They're all equal weighted, so we're not counting anything other than this. They're all the same. They're all the same weighting. What is the average return of this bucket of the best gross, or that is highest gross margin, the highest gross margins? And then what we do is look at the second best. Pretty big drop off. Seems to matter. Seems to be important. Third best, that's the mediocre. That's the middle of the pack. Significant drop off. Again, this really seems to matter. The second worst, there's somewhat of a drop off. So it's not perfectly smooth here. It's not linear. If it were linear, it would be like that. But at this point, each step down in quality has involved a step down in investment returns in the period after. Remember, it has to be the period after, because you can only use for investment what you know before the period of the investment returns. You can't look back and say last year was a good return, so I'm going to retroactively go back a year in time. You start off the year with the knowledge you have, and then you see what happens after. So there has to be, this return has to be after whatever metric you're using to decide who to invest in. All right, let's go one more. Oh, little non-linearity here. The worst are a little bit higher. I have a theory as to why that might be. It might be that if they're so unprofitable that they're also highly attractively valued. The stock price is so beaten down that they're really on sale. I don't know that that's what's happening. It's a good research project for us to look at later, but that might be a possible explanation. But clearly this is a lot higher than this. And these two combined or averaged together would be a lot higher than that. So gross margins, when you look at the past, gross margins as a measure of earnings quality has been additive when it comes to investment returns, and it's something that you ought to be thinking about. And it's also the reason why you watch Eagle Investing Network, to get insights like this, insights in advanced finance in very plain English. And that's worth subscribing to, isn't it? Especially since it's free. So subscribe to it and share it with somebody else. As always, thanks for watching.